Good evening and welcome to the Power of Passive Investing meetup. We have an amazing guest today, as always, and let me start first with our housekeeping rules. I'm going to share my screen. Just give me a minute, please. I can't believe it's the beginning of New Year. So happy 2023, everyone. I hope everyone is as excited as I am for the new year ahead. As always, the disclaimer, the presentation is for educational purposes only. We're not selling anything. Please consult your own professionals for any type of investment advice. This is strictly for education. Let our presenter do his presentation, but in the meantime, if you think of any questions, feel free to post them either in the Q&A or the chat box. And we'll go over your questions later. If you want to ask yourself afterwards, we'll unmute you and we'll let you ask your question after the presentation. Matt and I are thrilled to have everyone here, and these is our contact information if you want to reach out to either one of us. And let me just say a couple of words about Joseph. Joseph is actually a very good friend of mine. We've known each other for the last, I don't know, 5-6 years, maybe, just about. Time flies. He is a very successful investor. He's been in real estate for many years. He is also a licensed broker in Texas, and he runs a vertically integrated organization that includes real estate sales, both residential and commercial property management company, commercial acquisitions company, as well as a small media publishing firm. And without further ado, let me give the floor to Joseph. Welcome, Joseph.
Thank you. I'm glad to be here. Thank you, Alina and Matt, for inviting me. I'm going to share my screen. Let me know when you see it.
We can see it now.
Awesome. Thank you. So as Alina said, my name is Joseph Gozlan. I'm with the Eureka Business Group. And we're just going to talk about 2023, right? But talking about 2023 without talking about what happened in 2022 is kind of challenging. So what happened in 2022, right? So started great, ended up a disaster, right? I'm sure everybody feels that way, one way or another. So what we had, inflation go crazy, 40 years peak. We had the Fed going super aggressive and raising interest rates multiple times really, really fast. The last one was just recently, like a few weeks ago in the middle of December. The Fed also said that they will continue to raise rates. So that means we have a force that keeps trying to hit the brakes on the economy. We had tech stocks that got slaughtered, right? If you look at the NASDAQ, we lost 33%. And I always have to remind a lot of the stock market investors the way compound effect works. If I lost 33%, I need to gain 50% just to get back to zero, right? You're not a tech stock, and Facebook, yeah, lost 70% of their value from the peak in 2021. If you're not a NASDAQ guy, you're an S&P guy, everything is index funds, well, 2022 was a pretty rough year as well. 19.4% lost in the market. And that, again, compound effect, you need to get 24% gains just to get back to zero. And then we're looking at the worst year since 2008, top 7 since 1929. And here's the weird part, right? Inflation kind of helped break the damage. It's down 19.4%, but only because the energy sector was up 60% with all the cost, the increasing cost of gas prices. So really, in reality, if you were investing in single stocks, individual stocks, and you didn't have the energy sector in there, you probably lost even more than just the 20%. What else we had in 2022? We had the Chinese real estate bubble is about to pop, and it's kind of like breaking at the seams, and there's a massive government effort to try to contain this thing. We had multiple iBuyers shut down, right? Open Door is basically dumping all the inventory they have. We're in the Dallas-Fort Worth Metroplex in Texas, and there are over 500 just in our North Texas MLS, over 500 properties that open doors trying to sell, some of them with over 20-30% price drops already and not selling. Zillow already announced that they're losing money on that arm and they're going to shut it down. Redfin and OfferPad, the other big ones out there, they're not shutting down, but they've already announced that they're going to slow down everything. They're not purchasing anything right now. The labor market was and still is ridiculous. It's impossible to find labor. People don't want to work. All of our vendors are in the same situation. They can't find employees. We had the White House kind of redefine recession because it just didn't fit their narrative. And then remember what we said earlier, that the Fed is kind of trying to hit the brakes on the economy. Well, the administration is driving a truck, spilling oil on the road right ahead of that car that we're trying to hit the brakes on. So we have multiple forces kind of pulling things apart. We had some REITs that stopped sales because of liquidation issues. We're looking at 8.8% inflation in 2022 globally, right? So the US economy kind of slowed down the inflation rate towards the end of the year, but the world did not, and it's pretty bad out there. Well, what about crypto, right? Everybody thought 2022 is going to be crypto's best year ever. That's the year everybody getting into crypto. Well, no, not really. Crypto had one of the worst years ever. Almost every major coin out there lost more than 50%. We had the Terra and the Luna disaster that brought everything down to zero over there. We had the Solana losing $50 billion in value. And then I'm sure everybody heard about the last debacle with the FTX, right? A company with $33 billion valuation, and nobody knows where the money is. So not a good year for crypto either. What else we had? We had a war. The Russian-Ukraine war. I know it's not the US and we don't care about that, or we care about them from the humanitarian part, but not the economic part. Well, guess what? It impacts everything. Big energy crisis in Europe. They have tens of thousands of people without heat because of the high dependency of the Russian energy. Ukraine and Russia are the biggest grain providers for about 2/3 of the world. And that means there's going to be a lot of impact for developing markets. There was supply chain route issues, trade issues, even flight patterns were impacted because you can't send civilian planes over Russia and Ukraine right now. And that's a huge territory that doesn't allow flights anymore. So everything had to route around it. So not a great year. 2022 was just not a great year. So what does that mean for 2023? Where does it put us? What are we looking for? So Alina put a disclaimer earlier, and I'm going to put another one, right? I don't have a crystal ball. This is not going to be a science here, and I'm going to tell you exactly what's going to happen. This is just my 2 cents, my opinion based on what research I've done, the research I've read, the conversations I'm constantly having with financial advisors and bankers and people that are in different industries that are moving things. That's just where I gathered that information and formed my own opinion. So do your own research, form your own opinions, and let's get going. So in 2023, right, I'm going to work our way down from the global economy to the US economy to real estate in specific. The Russian-Ukraine doesn't stop, right? It's not going to stop tomorrow. It's not going to stop in a couple of months. This is going to last. And the Wall Street Journal just published an article recently showing that this is going to cost us about $2.8 trillion to the global economy by the end of 2023. Those third world countries that are dependent on the Russian and Ukrainian grain, this could very possibly plunge into a real famine. And this is going to be a humanitarian crisis that the world is going to have to deal with. Europe will suffer. Germany literally cuts down forests right now to get wood for heat because they were so dependent on the Russian energy and the oil and gas from them that they don't have any sources right now. And when the funny part is, like, if you go back a few years ago, President Trump was making a comment about that, and everybody mocked him. And guess what? He's probably sitting down and making fun of them right now. China's real estate bubble is probably going to pop despite all the government efforts, and we might actually see the first civilian unrest in communist China. There's a lot of protest and a lot of anger going on right now with the COVID restrictions they have in place. You throw on top of it an economic crisis, and that might be that chink in the armor that they're going to face. With that said, there is a small but not zero chance that China will invade Taiwan. That the easiest thing to avoid internal crisis is to put it outside and face an outside enemy. The Russian the precedence of invading another country in the world really doesn't do much over there other than throwing money at it. Is encouraging. China always had their eyes on Taiwan. And the last thing that just got added a month ago is President Biden signing the CHIPS bill, which basically prevents American companies from exporting chip technology to China. And Taiwan is the #1 semiconductor manufacturer in the world. So now they also have an economic and technological reason to go in there. So small, but not zero chance of that happening. The International Monetary Fund is already predicting about 6.5% inflation for next year globally. I don't know how many of you have heard about that, but the BRICS countries are pushing towards creating a new reserves currency. And this is not an immediate threat to the US dollars, but if that really happens in the medium to long-term run, this could be a very, very bad situation for the US dollars if they can create a more stable and coin that is used by basically half of the world population. COVID is still going to be out there, but because it doesn't need it for election and other narrative purposes, I don't think it's going to be a big factor for us until late 2024. So drilling down to the US economy, we're going to see inflation going down from the 8% and the 6% we saw at the end of the year to about 4 or 5%. It's not going down to 2, not anytime soon. That's my opinion. And it's going to stay at the 4 to 5% for a long time, multiple years ahead of us. And again, like I said, we have two forces pulling in different directions. The Fed is still going to continue to raise rates. There's no way around it. They have to keep their foot on the brake. There's probably going to be another 3 to 5 hikes this year, anywhere from 0.25% to 0.5%. I don't think they're going to be as aggressive as they were in the second half of 2022, but it really depends on how that $1.7 trillion spend bill going to end up looking. If they're going to keep printing money, the Fed is going to have to keep hitting the brakes. I think the stock market is going to see an optimistic start in the next month or two, just because it's a new year, everybody's optimistic, but I don't think it's going to continue and it's going to perform. I think it's going to drop. I'm thinking best case scenario, we're looking at a flat year at the stock market. The auto industry, I don't know anybody if you're following this or not, but they are building one of the biggest subprime lending crises since 2008. What they were doing back at the time, Wall Street was doing back at the time, 2008, pushing subprime loans on people that really shouldn't be getting any loans, then bundling those up into tranches and selling that to institutional investors, has been happening in the last 5-6 years in the auto industry, and now it's starting to break. There's a lot of repos, there's a lot of defaults on those loans, and there's if you're interested, there's a very funny YouTube video from John Oliver about the whole subject, and he's just giving an example of they picked a car and they tracked it, And between 2008 and 2011, it's been sold 8 times. And then they tracked it even longer, and it was sold even more after that. So just things to think about, things to realize. And if you're in the market to buy a used car, just wait a couple of months. It's going to be a much, much better price. On the labor market, we're going to continue to have the challenges, right? People are still going to resist going out to work, and they're still going to demand higher payments. Our vendors are still going to be struggling to finding good, solid labor. It's going to be continue to be challenging. The tech companies will continue to lay off. I know you've heard all the layoffs so far with Google and Facebook and Twitter. I've seen a few more companies that are a little bit under the radar, not as big as these guys that have been laying off. Just heard about a round of about 800 employees from an international company earlier today, tech company. So they're going to continue with the layoffs. The rising costs of credit is also going to drive businesses for bankruptcies. And it's sad, it's going to be small businesses. It's not going to be the big monsters like Facebook or Yahoo or any one of those. It's going to be your small businesses that are kind of dependent on the rolling credit, the rolling line of credit. And the cost of that is going to increase, of course, because all the rates are going up, and it's going to choke a lot of businesses out of business. So that's that. So with all these things coming together, we will see unemployment probably towards the end of the year soaring to 7 to 10%. And that, with combined with all the other factors we're talking about, maybe it's going to get the administration admit we're in a recession. But again, the way they redefine things every day, I don't know how it's going to end up being. I know I've been painting a pretty gloomy picture so far, but I want to make sure that everybody understands we're not looking at a 2008 level crash. We're not living in the same world. Back in 2008, I don't know if you guys have seen or been around back then, but if you lost your job in 2008, nobody was hiring, and you were basically screwed. You would lose your house, you couldn't pay the mortgage, you would be in a world of trouble. But today, you can jump in a car, you can do a little bit Uber, you can do some DoorDash, you can put your house on Airbnb and move into a small little apartment. There's so many different ways that you can earn just enough money to be able to keep your house and not lose your home. That the gig economy, I think, is going to basically not get us back into the 2008 situation, especially on the real estate side of things, because back in 2008, we had a massive oversupply. COVID kind of helped us with all the supply chain issues. A lot of builders just couldn't build as much as they wanted, right? So we don't have that oversupply we had in 2008. So with everything we've discussed so far, yes, it's going to be a challenging year, but it's not going to be a massive crash like we had in 2008. So let's keep going to drill down even further to real estate. I'm going to start with the negatives, and then we're going to go to the positives, because there are going to be a lot of positives in the real estate world. So what's going to happen in real estate, right? So for started, we're going to have a slowdown. There's going to be a lot less transactions than we had in 2021 and 2022 for multiple reasons. One, we have high interest rates for the mortgages. If I took a mortgage 3 years ago at a 3%, basically, if I don't have to sell, I'm not going to sell. And it's going to take a lot of the inventory out of the market, because people will look at it and say, okay, so I bought my house, it went up in value, but do I really want to give up my 3% mortgage to go get a 7% mortgage? That automatically takes out a lot of the downsizes, right? So it used to be that if I've been in a 5-bedroom house and the kids are out for college, I'll sell the house and I go get myself a 3-bedroom house or an apartment or a condo, and I'll downgrade and I won't have so much expenses. But if my 3% mortgage is $2,000 in my 5-bedroom house, and I'm going to go buy a 3-bedroom house, I'm going to pay $2,500, it's not a downgrade. It makes no sense. So yes, I'll have less of a house, but I'll have more of a payment. So we're going to see a lot of that go out. So a lot of the transactions basically are just not going to come to the market. Rents across the board in the residential side of things, I think, are going to be flat in most of the country. Some markets are going to go negative because they're just oversupply. And of course, there's always a few markets that are going to continue to grow, but nowhere near the rate that we're growing in the last 5 years. What does that mean for the multifamily guys out there? Well, we're going to look at a situation where operational effectiveness is going to be number one determining of a success factor. Because if, I bought in 2012 and I'm not a very efficient operator, it's okay, because 2023, 2024, 2025, 2013, 2014, 2015, everything goes up. All the rents go up so they can help me offset inefficient operations. But right now we're in a world where rents are going to be flat, costs are going to go up. So all the margins are going to get tighter. And if I'm not going to be efficient, it's going to be a problem. The other people that are going to get pressed are going to be our tenants. So if food costs more, gas costs more, insurance costs more, then I have less money for rent. And that's going to bring some opportunities to the market. We'll talk about that in a bit. Insurance rates are going to increase. That's been happening year over year for the last few years. The big hurricanes, those snowstorms, those ice storms, they're just causing so much costs. And the problem is that inflation makes everything worse. So the number of claims are going to increase just because of the weather has been going crazy over the last few years, right? Some poor bastard called it climate warming, global warming, but it's really global weather went crazy, right? So the winters are harder, the summers are harder. So we have increased amount of claims, but not by a lot. What we do have is every claim on average, the cost to repair it is going to go way higher because of the cost of material, the cost of labor, everything goes up. So the insurance company is a business. They have to find a way to offset it, and the customer is going to have to pay for it. So I know that my multifamily, we just renewed at the beginning of December, and we saw a 30% increase. So that was painful, yeah. CMBS loans, that's commercial mortgage-backed securities. If you have one that's going to go for the next 4 years, you're good. But if they're coming up for a refi in the next year or two, that's going to be interesting, because a lot of them are going to be underwater, and that's going to drive some distressed sales. Same thing with the multifamily guys that have a bridge loan from 2 years ago, and it's up for renewal this year. We're going to see the return of short sales. Short sale, for the people that don't know, is when you work with a seller to convince the mortgage lender to take whatever the house is worth, even if it's less than the mortgage balance. And that's really where short sales are. I think they're going to come back to the market, and we're going to see a lot more of those. SEC hired a lot of agents, IRS hired a lot of agents. I think we're going to see some sort of a crackdown on syndications with tighter regulations and more audits. And that's something that's going to be pushing some people out of the syndication world. We're going to see multiple municipalities issue ordinance and regulations around short-term rentals. And so far, it's been a great party on the short-term rental world, but we've seen way too many cities and counties cracking down with either taxes or just flat out shutting down things. I know in the Dallas market, we called, on behalf of our clients, we called hundreds of HOA companies, and almost all of them have added new regulations to shut down short-term leasing, limited to a minimum of 6 to 12 months. So that's happening today as well. Another kind of troublesome initiatives that are happening right now is there's a big push on Congress and the Senate to get rent control initiatives. And our current administration is very favorable to those initiatives. So things to be paying attention to, and we got to be something to worry about in 2023, that we might see some of these things coming up. And then this could come as a federal executive, like a presidential executive order or something like that, just like we had the eviction moratorium in 2020 and 2021. It could end up being something that we have to deal with. So that's the negative, right? So I think it's about time for us to kind of turn the tables and have a little bit of a more positive. And one thing to, before we go, this is California is one of the best things to look at when it comes to getting government oversight and authorities sticking their hands where they shouldn't. Alameda County just banned all criminal backgrounds as a screening criteria for your tenants. Alameda County is one of the top 10 largest counties in California. It's got over 1.6 million people. Alameda County is the top 2 violent counties in California. And now if you own a property in Alameda County, you cannot use criminal background to screen your tenants. And last time I heard, the California governor, Gavin Newsom, thought that it's a good idea and he might want to push it on a statewide initiative. So we don't like government interfering with these things. This is just an example of something that could come in and it's not great for anybody. So what are the positives, right? All of these scary conversation, all of these gloomy predictions, right? What's the positive things, right? So the first thing is to remember that all the people that lost a shit ton of money on the stock exchange and pulled it out are going to have to deploy the money somewhere. And historically, somewhere means real estate because it feels safe, it feels familiar, it's brick and mortar, it's in my neighborhood, I can put my eyes on it, I feel more comfortable. So I think that's a good thing. That's going to bring some more money into the real estate game. We can negotiate again. It's like in 2021, we had to look at our clients and tell them, well, I'm sorry, you're going to have to put $100,000 offer, and I can't promise that even that's going to work. So we're back into a world where we can negotiate, mostly because the people that are coming into the market, and we'll see that in a second, are coming from a place of, I have to sell. Remember, if I don't have to sell, I'm not selling. So now we have an opportunity to negotiate. I think that iBuyers are going to be one of the most interesting opportunities in 2023, going in and basically taking advantage of them like they took advantage of everybody else in the last 4 years. So if you're putting offers, go ahead, lowball the crap out of them, ask for repairs, ask for credits, ask for anything, because they are desperate to dump those properties. They are losing money every single month. So, and like I said, we've seen, at least in our market, we've seen 20-30%, and some of the properties, I've seen $280,000, $300,000 price drops, and they're still not moving. So definitely an opportunity over there. As I mentioned earlier, if they're on the market to sell, they're in a position of, I need to sell because I need to move. I have to relocate for my work. I got a divorce. Somebody died. I got to upgrade because we have too many kids and not enough room. Whatever the reason is, it's going to be from a position of, I have to sell. We're going to see, as I mentioned earlier, some distressed multifamily assets coming into the market, and that's probably going to be either from bridge loans that are up for renewal, or from projects, turnarounds that were supposed to come in and did not come in. That's going to generate some really interesting opportunity. Loan assumptions are a great, what I believe is going to be one of the greatest moves in this year. So if I have a multifamily asset or even a commercial asset that have a long-term loan on the property that is assumable, let's say a Fannie Mae loan that I took 3 years ago at a 3% interest rate, and it was a 10-year loan, so I got 7-year mortgage on the loan, assuming that debt is going to be very, very attractive. So it's a little bit longer process and a little bit more complicated, but definitely going to help the buyers get a reasonable loan in and get the seller the price they need in order to sell the property instead of being a distressed sale. So I think a loan assumption is going to be a good move for 2023. We think that a good move in 2023 is to transition into a long-term leases style of assets. So either industrial or neighborhood service retail, stuff like that, that have good solid tenants, recession-proof tenants, national credit tenants with 3 to 5 year leases, annual increases built into the lease. I think those are favorable types of assets in a downturn. Seller financing came back, and it's available. It's even offered a lot more. So I'm looking at whether it's the MLS or CoStar or commercial assets that we work with. Sellers actually started offering seller financing, and that's mostly because they realized that in order to get the price they want to get, it's going to have to be a combination of a sale price plus the interest they're going to get from doing a seller financing. And that's going to be a thing, I think, and a positive thing in 2023. So a few tips, and that's good for any challenging market, right? So now more than ever, know your numbers. As I mentioned earlier, if it was 2012 and I bought $1 million property for $1,200,000 to pay 20% over market, and now it's 2022 and the property is worth 3 times what I paid for in 2012 or 5 times what I paid for in 2012, I'm a genius. But if I bought something for 20% over asking price in 2007, and then I lost my shirt in 2008, not so genius, right? So timing the market is not something you should work for or you should plan for. Know your numbers, stick to your guns. That's how you're going to make good deals. And this is where we're going to come and see that, you know, a rising tide lifts all the boats. This year and next year, we're really going to find out which investors really don't have any pants under the water, because you can't keep going up constantly. Like I said, don't try to time the market. Prepare extra for the expenses. If you own properties or if you're about to buy a property, make sure you build the right reserves, because it might take you a little longer to fill that vacancy. You're definitely going to pay more for the cost of the maintenance and the repair and the rehab and the construction and contractor work. Everything's going to be more expensive. Your property taxes are going to keep going up. Your insurance is going to keep going up. So making sure you build a little bit more buffer and a little bit more reserve account is going to save you in a challenging market. Let's just say that when it's volatile and it's not very clear what's going to happen next year or at the end of this year. Build relationships. This is one of the best advice I can give, is build relationships. The first one is with local banks. Find that regional or local bank that has 2 or 3 branches in your area or in your state, or maybe across 2 or 3 states around you, and find the commercial lenders and start building a relationship. Because when the market's going to shift and there's going to start being foreclosures or pre-foreclosures, they're going to know first, because it's their bank, it's their portfolio. These guys don't sell the mortgages to Wall Street, they keep it in the bank. So they know exactly what's going on. So if somebody is struggling and they know that you're a person that can come in and buy that from out of the other person, and they trust you and they have a relationship with you, they will let you assume a personal loan, right? Small banks, usually it's full recourse loan, and they're not really like letting people assume those things because it's a full recourse loan, but they will let you if they have the relationship with you. So build that relationship. Another reason is, back in 2009, when the world just went up in flames, right? There were a lot of deals outside, but what we didn't have is funding. Most of the funding resources just dried up and it was really hard to get funding. So having those relationships will help you get funding. And they're going to get you a loan. You might not like the loan, right? But it's going to be a loan that's going to help you keep a property. They're going to help you buy a property that is a great opportunity. And then a few years later, you'll get a refi and you'll get a loan that you're really happy with. So that for those 2 reasons, I would start building relationships with your local bankers. Build a relationship with agents that know how to do short sales, because they're the ones that are going to help you get a great deal. And instead of waiting for it to go to foreclosure, and then you're going to have to pay for the bank's cost of going through the foreclosure. So getting properties that are pre-foreclosures, short sales are a little bit longer process, but they usually get great properties with great value. Build relationships with your local politicians and your local influencers. You want to know what's coming down the pike. You want to know if a city is going to hit a certain area, a certain neighborhood with ordinances or regulations that kills short-term rentals or changes zoning. This is how you find out if you want to go into an area or you want to run away from an area, or it's going to be good here, it's not going to be good here. So build those relationships. It's going to help you a lot. And then best advice for a real estate investor, right? If you're going to work with an agent, pick an agent that is an experienced investor, right? And this is where I'm going to put a shameless plug in and remind everybody that our team, all of our team are investors themselves. So with those tips in mind, right, it's an opportunity. 2023 is going to be an opportunity for everybody to think outside the box. What does that mean, right? The biggest wealth building opportunities are going to happen in markets like this. 2009 and 10 and 11 were the best opportunities to build wealth. If you bought a 100-unit apartment complex in 2011 or in 2010 or 2009, excuse me, in 2022, you did 10x on your money or more. So those are the biggest opportunity to build wealth, right? Learn and invest in learning about negotiations. This is where you make your money. Negotiating helps you get the better deal, get better terms, get seller financing, get what you need in order to make a deal happen. If you don't know a book name, Never Split the Difference by Chris Voss, I highly recommend it. It's a life-changing book. Absolutely. If you haven't read it, this should be the next thing you do after this presentation is go get that book. Prepare multiple exit strategy for every investment you're looking at, right? So if the only way to make a deal happen, if I buy it, fix it, flip it, and sell it at a profit, then I'm not buying it in 2023. I need to be able to prepare, and this is something that happened to a lot of people in 2009 and 10. I need to be prepared to turn it into a rental, or turn it into a short-term rental, or turn it into something else. I got to have multiple exit strategies so I can adapt and change direction if the market changes on me. Build an extensive toolbox, right, of creative ways to put deals together. Right? There's a lot of resources, Facebook groups, podcasts, books, YouTube videos, and internet forums, and so on, that will help you build that toolbox to know how to put deals together, because the more ways you know, the more opportunities you'll have to convert on an opportunity. This is something that is true to every market, but especially in a challenging market, in a volatile market, trying to find a way to repurpose an asset is going to make a lot of money to a lot of people, right? A few examples, right? You can turn a single tenant industrial into multi-tenant retail. And it's like we saw a property that used to be a 6,000 square foot dry cleaning plant. It was located on a major street with metal building, and somebody bought it, took away all the insides, put a brick facade on the outside, cut it into 6 pieces, put plumbing in, and now he's got a 6-unit retail on a high volume street. Took the property from here to here just by doing this little conversion. You can convert a rental into short-term rental. You can take a short-term rental, convert it into a corporate housing or midterm rentals. Think traveling nurses. You can take a single family, put multiple beds in it, make it into assisted living facilities. Any different way you can think of that will take it from being this into being that, as long as that is going to bring you more money. So repurpose is a strategy that generates a lot of money in these cases. We always tell people that are saying, well, I'm going to buy this, I'm going to do value add, force appreciation. I'm going to say, it's like, okay, what strategies do you have to value add? Well, I know how to raise rent, and if they don't charge for utilities, I'll do that. Okay, what else? So build that list, right? So when we go and underwrite a property and we look at a property, it's like, what can we do? How can we force appreciation? How can we add value? And I know personally, we have an Excel list of about 150 of those line items that say, okay, this is how we can increase value and force appreciation. Then we look at the property and say, okay, that's relevant, that's not relevant, that's relevant, right? So it helps us kind of quantify the value add instead of just saying, well, I'm just going to do a value add. Learn everything you can about taxes. Every business, and real estate is no difference, has two major expenses. That's payroll and taxes. And payroll, most real estate investors don't have payroll or don't have controllable payroll. So that's not as interesting, but taxes is what can make or break a deal. Sometimes the tax benefit you get from a deal can be dramatically higher than what you can get in cash flow, and it might be worth it for you. Opportunity zones, cost segregations, all these things, all those different tax strategies, even conservation easements, all those tax strategies that have a relationship to real estate, go and learn about them. Figure it out, learn how to use it, learn what benefits you can get from each kind of property, so you'll know what's best for you. The one thing is, a caution about that is, don't let the tail wag the dog. Right? I've seen way too many people invest $1 to save 30 cents on taxes. That makes no sense to me. So while you should learn about all the different tax strategies, does not necessarily mean that they're all great. Pay attention to what is right for you and what is right for the property at a specific time, instead of just applying everything you've learned everywhere all the time. So where are we going in 2023? What are we doing personally, right? So we've looked at the gloomy, we've looked at the opportunities. Where does that distill for us, right? I thought I would share that. And that's the last slide before we go to Q&A, because I see Alina looking at the clock. So for starters, we're staying in the South, right? Texas, Florida. This is UL. If you don't know, UL publishes all the time the one trips. So if I'm moving from anywhere to Texas, it's a one count for Texas in this graph, right? Because I take a one-way trip from wherever I'm moving to Texas, and I'm dropping the truck in Texas. So this graph looks pretty much the same every year, with a little bit of changes here and there, but the Sun Belt is always at the top. So we're staying in Texas. Our real estate team, our sales team, is going to continue supporting investors, and we support investors anywhere from their first rental to multi-million-dollar commercial grade assets. We're going to be there with our investors. On our acquisition side, we're shifting our focus to single tenant industrial and triple net leases, retail service centers, and self-storage assets, in that order. Negotiation is really what we do best as a team, whether it's our own acquisitions or our clients. So negotiating higher cap rates for our clients and for our acquisitions is going to be where we're going to make the most in this year. We're going to prefer JVs with fewer investors over the last syndications, the largest syndication methodology. We're going to generate partnerships with those small banks that I mentioned earlier, so we can be able to secure strong debt positions. And again, the thing that is the most challenging to get in rough economy is funding. So building those relationships and partnering with those banks is what's going to help us win and capitalize on opportunities. We're going to try to negotiate seller financing, seller second notes, whatever we can in order to help a deal work out better. We're offering commercial property management services, retail, industrial, office, and so on. And then we're going to continue to contribute, right? Educate investors. We're going to put our content out there, whatever we can to bring value. We will. So that's it for us. I hope I didn't go too much over time and give opportunity for some Q&A.
Joseph, thank you so much. This was phenomenal. It sounds like you do have some sort of crystal ball, whatever shape of that crystal ball is. I'm definitely in agreement with you on a lot of the points that you made. And even though it may sound sort of gloomy, I think it's not as bad as we've had in some of the years in the past. And you mentioned 2007, 2008 for sure. Okay, reading something Evangeline put in the Q&A. You're extremely well versed based on all you discussed. Do you think syndicators who buy buildings should cater more to what millennials want in order to drive them in and add value? And there's an example: invest in electric car chargers, stations, smart apartments, pool services, and so forth. Notifications for fast food delivery, storage, drone delivery, parking. Lots of millennials have good careers and pay their rent. I feel like once there is a culture, rents go up naturally due to the demand.
Yeah, so I'm going to answer that in two pieces, right? So the first conversation about the millennials, I've talked to a few operators that have gone that route, and you're absolutely right. Millennials are willing to pay more for a good service, but that also creates a situation where they demand a much higher service than you might have expected. So as long as you're prepared for that, and you know that you're going to have to step up your service game and be able to handle the requirements and the demands from that crowd, then absolutely they can bring a lot of value and they're willing to pay for a better service. Specifically to the second part, for all the different things you've asked about, there's a difference between adding an amenity that generates income versus an amenity that increases the stickiness or the attractiveness of a property. So if you put the electric car chargers in the parking lot, if it's free, it might be able to help stickiness and or attractiveness. But if you charge for it, it adds another line item of income. So I'm all for adding anything that can add a line item of income. Anything that doesn't really requires understanding what the costs are and what the impact is, and can you really compensate for that loss of income or increase in expense by getting more retention or getting I don't believe in organically raising rents, right? Because it doesn't matter if everybody around you is charging, I don't know, $1,800 for that 2-bedroom, and you're charging $2,100 just because you have a car charger or a notification when the food service arrives, is not going to make them pay $300 or $400 more a month. So every amenity that you think about putting in, the main question you have to ask yourself is, how am I going to get my money back?
Excellent. Thank you, Joseph. Matthew, do you have any questions while we're waiting for the audience to send us more?
Sure, yeah. Thanks, Joseph. That was super comprehensive. A lot of data points. You must have taken in to correlate all that information. I'm curious, you mentioned in your intro a little bit about you have a media aspect to kind of your group or your business. I would just like to hear a little bit more about that, how that's built up, how that adds value to the company. I'm just curious to hear a bit more about kind of the journey that side of your business is taken and what value that adds.
Yeah, so the media company has multiple things that some of them we've done and some things are in the works, right? So we have a podcast that we run for multifamily operators called the Apartments Operators Podcast, and we keep generating content, and that content gets distributed and help all of our other sister companies, right? Our entire vertically organization. It also helps me personally as an operator, because the reason I started this podcast, this is very selfish, is I wanted to talk to bigger, better, more experienced operator than me, and they're not always willing to give you an hour of telling you all their secrets. So you call it a podcast and you publish it, and now they're willing to sit with you for an hour and tell you all their secrets.
Yeah.
So I can tell you a lot of our operations and a lot of our improvement of our operation came from that podcast. We have books that we've published. We have books that are in the queue. One of the ones that I'm working on is called the 401k scam, and basically trying to wake up people from realizing that it's like the 401k is basically invented by corporations to get people to stop getting a pension, because people were living longer and it was costing too much. And if you look at all the outstanding pensions out there, they're collapsing. And I think a few years ago, the LA police and fire pension basically made cuts to existing people that are getting pensions. That was a big rough situation over there, but they just had no choice because they were collapsing. So we have the publishing as well. When we have properties, right, building a website for each property is very important. But a lot of people will just have random website that they paid somebody to build that doesn't understand the industry. So it might look pretty, but it's not catered to basically you want two things out of a property website. Like we're talking multifamily properties. You want it to generate leads and actual leads that get to your leasing person, and you want it to help your resident get to wherever they need, whether it's opening a ticket or paying online and finding their portal to pay rent and so on. So it took us a few iterations, but we kind of cracked the code on how to build that website. And now we have a template that other people that have multifamily properties come to us, and we help them build a website that has the right kind of template that caters to those two needs. And then we recently started building real estate courses. So just things for like real estate investing for realtors. That's going to be our first course coming out in the next few weeks. We're going to build commercial real estate for medical professionals, because a lot of our investors are medical professionals like doctors, dentists, and so on. And we realized that they don't even know the basics of how to get a lease for their own practice or how to buy a building for their own practice. So we're going to build a class especially for them to be able to handle all these things. And then everything that I mentioned help our brokerage and help our acquisition by basically generating. In today's world, if you're invisible, you're not going to do anything, right? I tell all my agents, like, there's no such thing as secret agents in real estate. Right? If you're a secret agent, you're not going to be successful. You got to put yourself out there. You got to generate content. So all those things, all those videos, we have VAs and we have people that video editors that put all these things together, generate a lot of content where we can put that media out there. And then we can do it for ourselves. We can do it for our clients. We can do it for everybody else, right? So that's the media side of our organization.
Excellent. Joseph, and again, going back to, you don't have a crystal ball, but since your brokerage concentrates on both residential and commercial, which one do you think will not necessarily collapse, but be on sale, if you will, first? Will it be residential or commercial? If people are on a lookout for properties, where should they look at first?
So the reason we have two divisions to our real estate team is because we want to be able to support an investor from the first rental property all the way to commercial. There's not a lot of people that can say, okay, I've never invested in real estate. Let me go buy a $4 million property. So let's go straight to commercial. Let's straight go to multifamily. So most investors start on the residential side. And being able to be there for them and support them on there was very important to us, which is why we have the residential division. I think the home buyers are going to get impacted. The home buyers and the home sellers are going to get impacted first. I think the residential investors are going to have a great time. especially with all the iBuyers collapse, right? There's going to be a lot of opportunities out there on the market. On the commercial side, there's a 120 to 180 days gap between the buyers and sellers. So the buyers, if I want to go and get a commercial loan right now, I'm looking at a 7.25% interest rate. But the sellers are still looking at, well, the properties last month were selling at a 6 cap or a 5.5 cap or 5.75. So it takes them 2 to 3 months to kind of catch up. So I think the commercial side of things is going to get in trouble, but delayed, right? Because by the time you realize that, oh crap, I got to lower my price, the buyers are already in worse situation than you'll realize it. So I think the smart commercial sellers that have to sell are going to sell faster, realize that, take the hit faster than taking a much bigger hit later on. But unfortunately, human nature is that they're going to delay that, and they're going to be 120 days behind. And I think we'll see the commercial real estate side getting the pain a little bit further down the year than the residential side.
Thank you for that. And folks, feel free to post more questions. I'll ask another one to just give everyone more time if you want to post more. So you mentioned that one of your personal targets for you and your group is triple net industrial. Talk a little bit about that. How did you choose this asset, and why you're giving preference that over, say, storage or mobile home parks?
Yeah, absolutely. So one of the most important benchmark we teach our investors and our clients is called headaches to returns ratios. And the more people you engage with, the more headache is going to generate. It's flat out simple. A lot of people think that multifamily, for example, is a real estate business, but it's not. It's a people business. You have people that you have to cater for, you have to take care of. It's their home, it's their environment. They got to feel safe. It's got to be clean. It's got to be maintained. So there's going to be a lot more interaction and a lot more headache. And unfortunately, a lot more cases where you have to deal with the dog ate my money order, and I didn't notice it was leaking, and so kind of situations. So we, as we got into the, I don't say the larger investments and getting into larger sized properties, we learned that we'd rather take a little bit less returns for a lot less headache. And this is what the single tenant triple net leases buy you. One, you deal with one tenant, not with 100, not with 200, not with 600. You deal with one tenant. That tenant is a company, and that company, if you do your due diligence, should be a good grade tenant, right? So our last transaction has a national level tenant that has a $600+ million revenue a year, owned by a Japanese conglomerate that makes $20 billion a year in revenue. So to say safe, nothing is 100% safe, but it's safer than a C-class or a B-class resident, right? That's one thing. The other thing is the way the leases are structured. Triple net basically gives me practically zero responsibility. If their toilets get clogged, their problem. If their window breaks, their problem. If the AC breaks, their problem, right? Most of it is their problem per the lease. That's what the lease says. The tenant will take care of all these things. The other real benefit of triple net leases is it transfers the risk of property taxes and insurance rising in cost over to the tenant. So in a triple net lease, basically you charge the tenant back for the cost of property taxes and insurance. So while a multifamily operator can raise rents every year, they also have to take a loss, right? It reduces from their NOI every time their insurance rises and every time their property taxes go up. On the triple net things, usually my leases are for 3, 5, 10 years with options to renew. My renewals are set in the contract. So if let's say my lease says 3% every year, if the rest of the market went up 5%, I am limited to the 3%. But at the same time, if property taxes went up 20%, not my problem. Insurance went up 30%, like I just mentioned on our multifamily, that all gets transferred over to the tenant. So, so for these reasons, kind of like we said, okay, let's look what's out there, right? So, industrial is very attractive because what COVID did to e-com, it accelerated e-com about a decade forward in 2 years. So a lot of the people that were still hesitant to do online shopping and all this thing, usually it's the older generation, right? Found themselves with no other options in COVID. So e-com got boosted, the technology got boosted, the volume got boosted. So when you outgrow your garage as a startup e-com, where do you going to go? You're going to go to a 3,000 square foot warehouse. And if you had 3,000, you'll go to the 8,000 square foot, and they'll go to the 15,000 square foot, and so on, all the way up to the 1,000,000 square foot of the Amazon warehouses, right? So that's one thing that is going for industrial. The other thing that is, again, COVID kind of exposed the lack of manufacturing in this country. So I think that in the next few years, we're going to see a lot of government incentives and subsidy to bring manufacturing back to the United States. The CHIPS bill that Biden just signed is an example of trying to keep technology and keep manufacturing in the country, because we couldn't even get Q-tips and toilet paper, right? It's that ridiculous. So, so again, with all those incentives, all the manufacturing coming back to the US, what do they need? They need industrial properties to be able to put their manufacturing facilities. So multiple things are working. Amazon is becoming this enormous beast, right? That keeps consuming more and more and more industrial space. So you have to do that. And then on the maintenance side of things, right? You got to, or the construction side of things, think about it this way. If you need to build a 100-unit apartment complex, you have 20 slabs and you have all those studs, and you have 180 bathrooms and 100 sinks and 400 windows and all this complexity. Well, you have an industrial property, you basically have a slab concrete, tilt-up walls, maybe 1 or 2 toilets. So it just makes things a lot simpler, a lot less headache for the investor, and you can hold it for a long time. The retail, the small service retail, is really where we're not going to recommend you go buy an Albertsons, or you're going to go buy a big restaurant like BJ's or McDonald's or White Castle or whatever it is. But we do like the service centers, right? Because Amazon still doesn't do your nails, cut your hair, get you a sandwich for lunch, or ship your box. Guess what? When you have to return something to Amazon, where do they send you? To the UPS store down the street at the retail center, right? So again, and those retail centers are also structured as most of the time triple net leases. And we talked about the benefits of triple net leases. So again, I'll deal with 4 or 5 business tenants instead of 100 or 200 tenants of multifamily.
Makes sense. Thank you, Joseph. On this note, we are going to wrap up this webinar. Again, thank you so much. Incredible presentation. Folks, it is recorded and we will be sharing the recording afterwards. Thank you so much and good night.
Thank you for having me.